Alright, so let's jump right into the chart. Don't worry about the names of these tools for now, just look at what's happening. The idea here is actually pretty simple. See this big ribbon? When it's green, I'm only thinking about looking for buy setups. It's just helped me filter out the noise. If it's red, I'm only looking for shorts. That's it. It's the first step to just align with what the market is already trying to do. Okay, so once we know the general direction, what's next? Well, this is where it gets interesting. I like to look at for those little consolidation boxes that get drawn automatically. Think of these as the market just taking a breather. After a big move, it needs to chill for a bit, right? That's like a tug of war between buyers and sellers. And since the main ribbon is green, we're basically just waiting to see proof that the buyers are gonna win this tug of war. And there you go. See that candle right there? It breaks out the box with some power. It's not just a tiny little poke. It closes strong above the area. For me, that's the visual cue. But this doesn't mean you just slam the buy button. You gotta have a plan if you're wrong. A logical spot for a stop loss might be right below the box. Why? Because if the price comes all the way back down there, my whole idea for the trade is clearly wrong. It's my line in the sand. And for a target, a common approach is just looking for a risk to reward ratio something like 1 to 2. That's just a way to frame the trade so you have a plan from start to finish. It's not magic, it's just having a process. Let's look at another one, but going short. Here, you can see the ribbon flips to this solid red. The whole mood of the market just changed. So what do? I immediately stop looking for buys. My brain is now only hunting for a reason to get short. And look, here comes another one of those consolidation boxes. We're not getting faked out by any little move up. We're just being patient, waiting for a breakdown that goes with our red ribbon. And boom, that's the candle that breaks down. Again, see how it's clean, a strong move? The sellers are clearly in control. The exact same thinking applies here. Just flip upside down, a potential stop loss could go above the box and you'd look for target below. The magic stays the same no matter which ways the market's going. But honestly, finding these entries is only half the battle. The most important job of any good framework is to keep you out of the bad trades. And this is what I really want you to see. Look at this situation. The trend is clearly down. The market's weak. But look, the box gives us a breakout signal to the upside. It's a buy signal. A lot of people would see that and jump on it. But for us, that's a massive red flag. Our rules say we don't buy when the trend is bearish. This is a direct conflict. The framework is basically a screaming stay out. It's a trap. And this is where the discipline comes from. You just follow the rule. And look what happens. The breakout goes nowhere, completely fails, and the price just rolls over and continues down. That right there. Avoiding that one losing trade is just as important as finding a good one. Okay, so you've seen the thinking. You'll see how we can identify the trend, find the potential entry, and most importantly, how to filter out the junk. But that leaves a pretty big question, right? How does it actually do that? Let's talk about how you could set this up on your own chart to study it. First thing, on a clean trading view chart, you're gonna go up and click the indicators tab. The first tool we're gonna look for, the one that draws the boxes, is called the trend range filter. So just type that and add it to your chart. Now the default settings are fine, but I find that it can be a little slow. So I make one tiny little tweak. I go into the settings, that little gear icon, and under the inputs tab, I just change the minimum range length to 14. That's it. It's just make it a little more responsive. Alright, but hold on. And this is super important. If you only use this one indicator, you're going to get chopped out. It's gonna give you a ton of false signals. Why? Because it has no sense of the overall trend. Remember that trap we just looked at? That buy signal in a downtrend? The trend range filter will give you those all day long by itself. It's only doing half the job. So how do we fix that? How do we avoid those traps? Well, we add our second layer. This is our master filter. We're gonna go back to the indicator search and this time add the market bias indicator. This is the ribbon we've been looking at this whole time. Its only job is to tell us what the main trend is. And here's how we put it all together. The only rule we need to remember is this. The two indicators have to agree. That's it. If the market bias ribbon is green, you're only allowed to look for upside breakouts from the trend range filter. If the ribbon is red, you only look at downside breakouts. If you get a buy signal but the ribbon is red, you ignore it. It's just noise. This one rule is what filters out so many of low quality setups. And for those of you who really want to be selective, here's the last little detail I pay attention to. So see how sometimes the ribbon is bright, solid color, but other times it's a darker, duller color? When it's bright, that tells me the trend is strong. When it gets dark like this, it suggests that the market is getting choppy and uncertain. For me personally, these are the times I just prefer to sit on my hands and wait. It's one last little filter to help focus on the cleanest looking setup. Now look, the whole point here is just to share a framework for how you can think about price action. This is all about educational purpose, and it's definitely not financial advice. If you found some value in this breakdown today, do me a favor and hit that like button. And make sure you subscribe so you don't miss out the next one. Happy trading!